Today we are going to talk about types of mutual funds.
Okay, so one of the categories of mutual fund type is basis on the structure.
Right. I guess the question is that basis on structure, mutual fund can be an open-ended fund or a closed-ended fund. So, and there's something called as an interval fund too. But let's broadly talk about. Let's keep things simple and talk about what is open-ended, what is closed-ended for now.
So for the sake of simplicity, we can think of open-ended fund as a fund in which you can enter and exit anytime that you want. You can invest whenever you want and you can redeem whenever you want.
Okay.
Obviously, redemption might have some constraints in terms of, but the option of coming out of the fund is available to you, even at a penalty. So you can take an example of fixed deposit. Fixed deposit is an open-ended deposit. You can enter any time that you want. You can exit any time that you want. If you exit before the stipulated time of deposit maturity, you will be charged a certain premature closure of fund. It is as similar as having a fixed deposit.
Okay.
On the contrary, if you think about closed-ended fund, they open for a short-term period. Usually, closed-ended fund will open for, usually they will open as a new fund offer. They will open for a short period. Only for that period you can subscribe for those funds. And then subsequently they are closed since then, and they have a specific duration of maturity. So it can be a 2-year closed-ended fund, it can be 3-year closed-ended fund, it can be 5-year closed-ended fund. All your equity and debt fund primarily in the market would become a part of the open-ended fund. So for example, HDFC Top 200 Fund, HDFC 100 Fund, Kotak Standard Multi-Cap Fund, all these are open-ended funds.
Right.
Closed-ended fund could be capital protection fund, like a 3-year capital protection fund, or earlier there used to be a lot of NFOs. Like for example, ICICI has this series of value funds. So ICICI Value Fund Series 1, Series 2, they I think went up to 18 or 20 series.
Okay.
So they came with a specific objective. So for example, they were launched in I think 2014, started with an objective of investing in value stocks, and they had a 3-year horizon. So it was locked for 3 years. After 3 years, the amount will mature and it will come to your account.
Okay.
There's a category called ELSS category. ELSS category is a type of mutual fund in which your money is locked for 3 years, which means you cannot withdraw before 3.
Yeah.
So there is something called as lock-in fund. What people usually confuse closed-ended with is a lock-in fund.
Okay.
So a lock-in fund is where you cannot take your money out of it,
Okay.
but you can still subscribe for it.
Okay.
So Access Long-Term Equity Fund is a open-ended fund, which means you can subscribe whenever you want. It is always open for you to subscribe.
Okay.
But it has a lock-in of 3 years.
Okay.
Which means you cannot withdraw before 3 years, but you can subscribe whenever you want. Whereas a closed-ended fund, on the contrary, you cannot exit or entry anytime that you want.
Okay.
So, for example, the value fund as I discussed, it opened only for 10 days period. So you can subscribe only for that 10-day period. And later on, once the subscription time is closed, you cannot subscribe for it. So you cannot enter, and obviously you cannot exit it.
Okay.
Right. There's also one small catch. So all these closed-ended funds that are there, like for example, the value series, the capital protection fund and stuff like that, they are tradable in the market.
Okay.
Whereas the open-ended funds are non-tradable in the market. Non-tradable as in they are not listed. So for example, when you buy an open-ended fund, like Nippon India Blue Chip Fund, which is a large cap fund. So this is an open-ended fund, which means you can enter anytime that you want, and it is a non-lock-in fund, which means you can exit anytime that you want. Now this fund invests in some of the stocks. Let's say it holds 50 stocks in its portfolio. And these stocks are tradable, which means they buy and sell stocks depending on their horizon and their call of different investment scenarios and markets. But this fund itself is not listed to any exchange, which means if I am a holder of 1000 units of Nippon large cap fund, I cannot go and trade with you.
Okay.
What I can do is I can redeem the units and I'll get the equivalent money in my account.
Okay. Yeah.
Whereas these closed-ended funds, like for example value series funds or capital protection funds, these are listed in the exchange and they are tradable in the market.
Okay.
But the liquidity is very less, so virtually no one buys them.
Okay.
So you can fairly assume that you cannot get your money before the maturity period.
Okay. So basically, they're there on the exchange. Theoretically, there's a market for it.
Correct.
But practically, there's basically no market for it.
No buyer.
Yeah, no buyer for it. And I guess the relationship in a mutual fund is between you and the company that is managing your overall portfolio and overall money, and you're trading with them. Closed-end funds, you can do that when the tenure ends and when the tenure starts. But in interim period, theoretically, you can trade it amongst any n number of participants, but it rarely happens. Okay, going back to the ELSS example, right? So let's say I buy that type of fund and I currently have it in my portfolio and actually do. So now a case comes wherein, let's say I end up redeeming it. You're saying that the sale would not go through right now?
Correct.
Oh, okay.
So it's basically a open-ended lock-in fund in technical terms, you have to call it is an open-ended lock-in fund, which means you can subscribe anytime that you want.
Okay, but you can't exit.
But you cannot exit it because it is a lock-in fund in nature.
Got it.
Then there is something called as interval fund. So interval fund is basically a closed-ended fund that is open for different purchase intervals. So the example that I gave, a value fund, for they launched in 2014, they had a 3-year horizon, so it matured in 2007, and you could not buy in between. So it only you open for 10 days period. But there were few funds at that point of time, especially of IDFC fund, which were in the form of closed-ended, as in they have a certain maturity period, let's say 3 year or 5 year. But depending on the market situation, they opened those funds for small durations of 2 days, 5 days, 4 days, for investors to allow to purchase units into them. So for example, I'll give you an example. So let's say I decide a fund, I put down a fund as a fund house of a 5-year duration, which means you purchase today, it is open for 10 days, and it will mature after 5 years. And it is an equity fund. Now let's say you invest today, and after 1 year markets are down, and the fund house feels that we have a decent enough buying opportunity in the market. So what they will do at this point of time is they will open it for 3 days, 4 days, 5, depending on the scenario, and they will allow investors to enter into that fund.
Got it.
So this will be form of an interval fund.
So as a retail investor, I've actually never bothered with closed-end funds till now. I guess I'm guessing that relative to the market for open-ended fund, the market for closed-ended fund would be pretty small, right? Like
no, so market for closed-ended fund are decent because closed-ended funds offer high commission to the distributors, and they are sold very heavily by distributors because of the fact that the fund manager knows that the money will stay for a certain duration, and hence he can offer that commission to the distributor. Let's say, for example, in an open-ended fund, I don't know when you will redeem the money, so I cannot commit a commission to the distributor. Whereas in a closed-ended fund, I know that this money will be for 3 years. It happens in the industry that many times fund houses, what they do is, if it is a 3-year fund, and every year you are supposed to pay commission of 1% to the distributor, so they will advance all the commission and pay 3% upfront.
Right.
So if I'm a sales guy, I'm getting 3% against an open-ended fund which is giving me 1%.
Okay.
So there were times in 2014, 13 to 15, when there were funds which were offering as high as 9%, 8%, 10% commissions for a 5-year fund. There were 7-year closed-funded fund also at that point.
Okay, in the interest of time, let's move ahead to some other types of mutual funds because there's so much to cover. I guess we read always about based on asset class, which basically in simple terms means that where the fund is actually putting their money. So what are the types of asset class where the investor puts money and the type of funds which are available in the market, right?
So broadly, you can think of 3 to 4 types of funds in this category, depending on the asset class. Most of the investors know about 2 categories of funds, which is equity and debt. So equity funds, those funds who are into equity category would invest primarily into stocks. Or shares, that is commonly called. जबकि debt fund में क्या होगा कि debt fund में investors will invest into a debt category. Debts are usually to fixed income category or bond. So they will primarily invest into bond. It can be government bond. It can be private bonds, debentures. It can be short-term bond. It can be long-term bonds. And different kind of funds operate into this category, which we'll be discussing later on as well. But broadly, they will invest into bond category. The feature would be a specific amount of fixed return would accrue to them.
Okay.
So equity fund is a kind of mutual fund which will invest in a different type of stocks. Essentially, it can range from 20-25 stocks to as high as 50-60-70 stocks as well, depending on the fund. Whereas on the contrary, a debt fund will have bonds. It can be government bond, it can be debentures, it can be private companies bond, it can be short-term, long-term, different kind of bonds with different maturity. The third category, which is one of the most talked about, highly sold category, is the hybrid category of funds.
Yeah, most abused category is a better word, yeah.
Yes. So hybrid fund, as the name suggests, is the hybrid of equity and debt. So it will have a certain proportion of equity and a certain proportion of debt.
Right.
If the equity is higher, it is called as aggressive hybrid fund. If the equity is lower, it is called as conservative hybrid fund. So for a fund which has about 70%, 60%, 80% equity and 30-40% debt, it will be called as aggressive hybrid fund. Whereas a fund which has a lower proportion of equity, so let's say 30-40% of equity and 60-70% of debt, will be called a conservative hybrid fund.
Right.
A conservative hybrid fund gives an impression to investors that it is a conservative in nature, but that is not the case. If you look at the category of fund, it will be aggressive in nature.
Okay.
So these are just nomenclature for investors to understand as to what they are getting into. I don't know what kind of balance they provided, but it was promoted heavily in the market.
Flavor of the season.
The fourth category is a money market fund. Not much known or talked about category, but basically it is a kind of fund where investors invest in a smaller duration debt fund. So basically, for example, this fund will invest in short-term bonds or cash. They will have decent amount of cash. They will have, let's say, a treasury bill or certificate of deposit, something of that sort. So they will have a short duration investment, and most of the investors invest in these kind of funds with a short duration horizon. So if anyone wants to park for a short term, let's say 3 months, 6 months, or most of the corporates which might have immediate cash requirement, but they don't want to take any long term call, and they don't want to park in FDs also because FDs usually give a lesser return for a short term. So they might say as an alternative park into these kind of funds. So you can park for 3 months, 6 months. It is very frequently used.
And this category is something called investment objective, or like what's the intent of the investor in getting value out of the money that they're putting in. So we have a bunch of things like growth, income, liquid. Even when we go on a portal, we try to select one. ELSS we briefly mentioned, capital protection, fixed maturity, and a bunch of other things that come in. So yeah. What's up with those?
So usually when you invest, they come across 4 important terms in any name of the fund. Unless you take an example of Google Kotak Standard Multi-Cap Fund. So you will have 4 options here. Either you can have a growth option or a dividend option. Also you can have a regular option and direct option.
Okay.
So regular and direct is also one category of fund which we have discussed upon in our earlier podcast. Let's talk about growth and dividend option. So growth, the idea behind growth is if you are investing in any fund or any stock, and whatever return is coming out of those stocks, either or that bond, either in the form of capital appreciation or dividend, that money after realization is invested back.
Okay.
And the entire money hence drives the growth of the fund. So for example, let's say you invested 100 rupees in a stock and the stock value after 1 year increased to 110 rupees.
Right.
And in that 1 year, the stock has also given you a dividend of 10 rupees.
Right.
What has happened is you have increased your value by 10, you got a dividend by 10 rupees, so your total gain is 20 rupees.
Okay.
So the 10 rupees dividend that has come to you, that dividend is again reinvested to buy the unit of that stock in the mutual fund.
Okay. So basically you're recouping the money and reinvesting it back into the same mutual fund more and more. But I mean, my question is like, how does an investor decide which one to go for? Like, do we go for a income one? Do you go for a growth one? Like, is it based on your risk tolerance, your needs of an investor? Like, why do these categories even exist, and how do you make sense? Like, how do you make use of them in the first place?
Actually, it depends on the objective of investment.
Yep.
So probably a retired person who does not have a very long-term horizon and who is into a cash requirement, he might opt for a dividend option. He still wants to invest in stocks, so he might opt for dividend option. Investor who has a long-term horizon, he doesn't require any immediate cash, so he might opt for a long-term growth option.
Okay.
The catch here is dividend is taxable right now. Earlier it was non-taxable from equity. So most of the investment now goes into growth option. But if anyone falls into a lower tax bracket, so let's say if I'm a retired person and I don't pay any tax to the government, and I want to opt for dividend. Let's say if I don't require cash flow, but I'm not sure as to how markets will pan out in future. I mean, we took an example where the stock becomes from 100 to 110, it might as well become 90 also in a year at the end of the year. But it might be possible that within that 1 year period, the dividend of 10 rupees has still come. And if I am not a very aggressive or not a very long-term investor, I might as well think, okay, let me keep the stock as it is and let me take the advantage of the capital appreciation, whatever I get in the defined duration of time of my horizon. But whatever dividend comes to me, let me realize that and let me have in my pocket so that at least I have that money with me.
Okay.
That kind of investor could also opt for dividend.
And then they can rebalance their portfolio. They can
rebalance. They can later on invest as and when they want. They can use it for their own expenses. Growth and dividend option in equity. There's also regular and direct. So regular essentially means that you're investing through a distributor. Direct essentially means you are opting from a direct mode of investment, which in fact removes the distributor, and hence the cost comes down.
Let's take a pause there. I think we've gone through a bunch of funds. There are things like international funds, global funds, index funds. Index funds we'll talk about in more detail, I guess. That's an important thing to cover. But I guess we can spend hours and hours talking about these things, and there's some element of risk-based funds, like some funds are high risk, some funds are low risk, and depending upon your tolerance, etc. But I mean, if we go more into detail, we probably just might keep talking about for another hour or so. So I guess it's a good primer right now, and we can continue talking about more stuff as and when things evolve. When terms come in, we'll also define them. So it's okay, I guess. Okay. After these things are done, we can. I mean, probably, at least for me, I mean, we can start talking about some more interesting stuff. The financial industry is always something interesting happening, especially with debt and all that stuff which is going on in India right now. So we can talk about that. We can talk about some other
Correct.
stuff.